Bruce, it's time to bring you in. I know everybody is waiting breathlessly to see what you have to say.
Expectations are so high.
Always. You always meet them. Actually, you always exceed them.
Oh,
As far
okay.
as our viewers are concerned, they absolutely love your segments. So I won't take
Well,
up any more time.
I am thrilled to be here, always. And two things. First of all, I'm a school teacher, and so I have a homework assignment, and that is that. So this is my blog from September 24th of 2015. So everybody go look that up, and it's distribution definitions, and you're going to see the distribution schematics and some description of them. And I want you to look at schematic number 1, and I want you to compare it to a daily chart of canopy growth, CGC, which Tom just talked about.
Hey, Bruce.
Yes.
I'm not seeing the blog or any charts. I don't know if you're showing those. I just wanted to.
Oh, no, I was just going to have everybody go look at that. Are you seeing the first screen here?
Yes, power charting.
Yeah, okay, good. I just was given that as a homework assignment.
Okay.
It's just it's just me, being me.
Okay, I just wanted to make sure that you weren't showing something that wasn't appearing on the screen. Go ahead.
Yeah, so they should be able to go into my blog and go into the archives and find that. And that's a really good one to print off those schematics and look at. But here, and also you can find a lot of that material here at, first of all, there's my blog on stock charts, and then there's also other Wyckoff education that you can find that's free content on the YouTube channel, which is there, and also at the website that Ramon has, wyckoffanalytics.com. Lots of good free content. So please go check that out as we talk more about Wyckoff. And then let's go. So what I want to do today is spend a few minutes sort of talking about what I think is a really important event that happened in 2018, which is in January, was the very sharp decline that we had after a big climax that occurred into the middle of the month, into the middle of January, and then a pretty sharp decline, which set up what we call a change of character. And really what we've had since is sort of a big, gigantic trading range. And, whether this is the beginning of, or this is the construction of some kind of distribution, or whether it's a reaccumulation or just a big trading range that's going to go on for a while, something really big and important happened there and has been taking place through the course of the year. And I believe this to be either a reaccumulation pattern or whatever that is being caused by rotation. And this rotation that's occurring is what I really want to talk about today, because if we can sort of embrace the idea that the market is in this big sort of a sea change, we can identify where money is flowing away from and where potentially it could be flowing to. And so I want to do this as sort of a story in 3 parts, which is here we see that in this chart, which is the S&P 500 from 1977 to 88. And underneath that is a relative strength chart. And the relative strength chart is really pretty straightforward. And that is, it's the NASDAQ composite compared to the S&P 500. And so this is really a discussion about growth versus value. And we identify the S&P as being sort of these big, mature companies that have been around for a long time that have, growth potential, but the growth potential is maybe modest compared to some of the really fast-growing NASDAQ type stocks. And so we're looking at the NASDAQ as being our growth index. The S&P is our value index. And arguably there are better ways to look at this, but I think that this tells a good story. And so you can see that when in the bottom chart, when the line is rising, that growth is leading. And so the rising line means that the NASDAQ composite index is outperforming the S&P 500. When the line is declining, it means that the S&P 500 is outperforming the NASDAQ composite. And so notice that from the late 70s into 1983, you can see that there's generally rising trend of growth type stocks relative to the S&P. And this was a period where there was a pretty deep recession back in 80 to 82. And then thereafter, a robust big bull market that occurred from 82 onward. And the thing is that if we're not really aware of what's going on between growth and value, we have the potential of being in the wrong place at the wrong time. And this particular chart is a really good example of that. So, and also this is about the time that I was very young in the business. I just had become a financial person in the industry and was sort of floating in when the growth stocks were acting really, really well. And so you can see here in the 82 to 83 period that there's really just a dramatic blow off in this relative strength indicator. This was an IPO boom. And this was my first IPO boom that I experienced. And it was really quite dramatic. And this climax that occurred into the middle of 83 was came at approximately the same time as a correction occurred in the market. Somewhat of a gentle correction, but it was a correction in the market as defined by the S&P. And thereafter, there was a big, robust bull market from 84 to 87. So you can see, though, look what happened to the growth stocks. Is the growth stocks just tumbled. And if you had been heavily invested in growth type names in your portfolio back then, you had severe underperformance. And the place to be was in the more value oriented, mature names that are dominant in the S&P 500. And so this is really kind of where I'm going with this today. And that this discussion really is about, are we in the process of going through a sea change where we're going from growth orientation or emphasis to a value emphasis? So the thing about the difference between the two and the environment that they both have is that growth tends to be an investment that performs best when you have certain characteristics that are behind it in the economy. And one of them is that you have generally higher taxes. So, and this is not a political statement at all. This is just us as investors trying to understand the environment and what are the assets that can work best for us in that environment. So back in the 70s and into the early 80s, we had high taxes on capital. We had high taxes on dividends. We had high income taxes. Generally, this kind of an environment favors growth stocks because think about growth. Growth stocks are companies that have this great potential because they generally are smaller companies with good products, good innovative new products, where they can reinvest their capital and grow their businesses at a very high rate. The thing is about growth is that you can defer taxes on growth indefinitely into the future. You buy good growth stocks, you hold them for a long period of time, you create gains, but they're unrealized. You're not creating a tax event by holding these growth stocks. Well, what happened in the early 80s is that there was an emphasis, there was a change of taxation towards lower income taxes, lower corporate taxes, lower taxes on dividends. In other words, capital was taxed at a lower rate. And as a consequence of that, the thing that happened was growth had gone way up, growth themes, and they had become extremely overbought, and they had become very expensive. And at the same time, you had an orientation or a change from because of taxation more towards value-oriented investments, which benefit from low taxes. And so as a result of that, around 1982, you started to have a change of taxation, and at the same time, you had a blow off in growth. Okay, having said that, let's move on. So here is a period from 1995 to 2005, and you can see that this was a dramatic bull market in the S&P 500. Well, notice this, around 1998, there was all of a sudden this big explosion of interest in growth stocks. Well, this was a period that was generally a period where taxes were somewhat higher, capital gains taxes had gone up, income taxes were generally a little higher, and so on, and growth all of a sudden took off, and you had this period of time where, and this was a huge IPO boom. This was the dot-com era. And so growth really just exploded towards the end of the bull market, in the second half of the bull market. And at that time, you had this blow off, and then both the S&P 500 and the NASDAQ composite both went down, and went down into 2002, 2003, where we had a change of orientation towards taxation, which tended to benefit value stocks. And so you can see that when this line is low and flat, that value stocks generally are doing better than growth stocks. And you can see here that this rising trend in the S&P 500 was benefiting the value names. Now, if you'd owned certain industry groups in this decline from 2000 to 2003, you didn't even notice that there was a bear market. And that was home builders, bank stocks, oil stocks, oil service stocks. There were home improvement. There were many groups that just didn't miss a beat. They went sideways for a while in the bear market, and then they started to go up on their own. These were deep value stocks and benefited from this change of environment. So now coming to the current period, this is from 2012 to 2018, you can see that the basic theme that we've had in this bull market has been growth. Growth has been dominant. You can see higher highs and higher lows throughout on this relative strength line going from 2012 to the present. And the S&P 500 has done wonderfully in that period of time. It's been a great bull market all the way through. But if you'd been in growth, you would have outperformed. It would have been a better place to be, or let's just call it the best place to be. And then what happened? So here we are. Let's look at 2018 here. You can see a climactic blow off in the growth relative strength line. And you can see that in January on the S&P 500, you can see this peak that we had early in the year, and then a sharp decline, change of character, and now we're in this big trading range. Well, what's the thing that happened at the beginning of January? Is we had a big tax change. And so we had a tax change where corporate taxes came down, taxes on capital came down, dividend taxes, and income taxes. And so at approximately the same time, we had this huge sea change in the market, where all of a sudden growth, which it took a few months after that for growth to blow off, but look what's happened. Now you have a pretty sharp decline in the relative strength of growth to value that's occurring right up to the moment. And so I believe we have a sea change it could be that as it did back in 2000, it might be where both growth and value have to go through some kind of a bear market together, or it could be that we have growth take a steeper tumble like back in 83, 84, and value has less of a tumble or maybe just goes into a trading range for a period of time. But there's a rotation that's occurring here. And this rotation and the orientation of this rotation is going to be that growth is going to, I think, stall here and value is going to take over. And if we are aware of that and we use the right tools, we'll be able to identify where our capital can work the hardest. And of course, the stockcharts.com has the very best tools for being able to do this. So one last chart on this, and that is that what I've done is I've taken the Vanguard Value ETF and the Vanguard Growth ETF, and I put them up for the entire bull market going back to 09. And then here's a relative strength with growth when the line is rising, as on the other charts, growth is leading, and as the line turns the other way, value is leading, as defined by these two ETFs. And so you can see here that we had somewhat of a blow off that occurred into 2018, and now you can see that there's a pretty good decline that has occurred off of that peak, which indicates that value is starting to dominate over growth. And so I think we're at a point in time where we want to start to think about how we want to rotate our portfolios to benefit from this change. So let's now look at some specific examples. So here, I'll have to keep track of time here. Here is a chart, an ETF that I have been following since late June, and it is my proxy for the FANG stocks. And so this is the First Trust Internet Index, and the symbol is FDN. And we started to follow it back here at the end of June, and said that with this sharp break that we had in June, that FDN was going to go into a trading range, and for at least the third quarter. And in fact, that's just what it did. And then at the end of the third quarter, we wrote another blog that has the FDN at a hinge. So you can see how lower highs are being made, higher lows are being made, and it's coming into this hinge area where it's going to resolve itself one way or the other. And in fact, it resolved itself with a decline. You can see that this decline was dramatic. This is a very sharp decline for this index. 35% of this ETF is FANG stocks. All the FANG stocks are in here. And then there's other FANG-like stocks that make up the rest of the portfolio. So you can see that this is a very sharp decline. And we have a point and figure chart that we have put up. And this point and figure chart counts down to 114, 110. And we've gotten as low as around 117. So there's still potential to go further. Now, the thing that we are wondering is whether or not this count could become even bigger. And so we're going to keep an eye on this, because a rally up into a lower high here could produce a count that could cross this entire area and make for a very large distribution count. So this is sort of anecdotal evidence, because these FANG stocks are the type of growth stocks that have done so well in this bull market. So we've had this wonderful appreciation in these stocks, and now all of a sudden they're behaving very differently in 2018. And I think that's related to some of the changes in the way capital is being treated in the economy, and that also the growth of the economy which is partly related to the way capital is being treated. Banks are willing to lend more to businesses and so on, is causing this rotation. And we want to benefit from this rotation. So here is one piece of anecdotal evidence. And the other thing I want to show you is in June 30th, we did this point and figure chart in the blog. And you can see that this accumulation area here earlier in the year was fulfilled. It came within 2 boxes of hitting the top objective of this point and figure count, the large one. And then from that point on, it became overbought in this trend channel, turned down, and now it's down to this, it's gone as low as this 117 area right here. So you can see this is a huge tumble for these stocks. Okay, so there's one example. Let's look at another. This is certainly one of America's favorite stocks. It's one of my favorite stocks. I love to follow it, analyze it. It's a great company. And this is Apple. And so Apple, this, you can see here that this is a blog that I wrote back in September of 2016, and you can go back and look at that. But here was a point and figure count, a reaccumulation count that was taken at that time. And that reaccumulation count, which was, arguably not finished yet, but we published the blog anyway, gave a count up to 204,197. And so that count, and there was a nice little distribution count in here too, and it came within 1 box of hitting it perfectly, is this reaccumulation count was generated with a count line at around 100. I think it was 96. And the Apple was 115 at the time. And it's jumped out of there. And let's look at what happened. So here's a current chart, point and figure chart of Apple. And what I did is after this reaccumulation count here, which is the lower count, did complete, you can see it had one more push up and then a backup. I counted from that point across. It gave a count of 215, 231. And then there was a reaccumulation count that confirmed, and we love when this happens, it confirmed the lower count. They both matched, and look what happened with Apple. As soon as it got up into that area and touched that 231, 226 area, it stopped, turned back down. There was comments today, I think from Aaron, about how Apple is trading right now, and you can see that there's a huge change of character here. Again, Apple's been one of our favorite big growth companies, and arguably has got great value too, but it's the emphasis of Apple is that it's one of our big growth leaders, and Apple has shown a change of character here. Now, this is not to suggest that Apple's in a bear market. This is just saying that Apple's going to need time to either reaccumulate itself for another move, or it's going to potentially even distribute itself. At this point, it's too early to tell, but we do know that we have used up the fuel in the tank here for higher prices, and Apple needs to take a rest and reaccumulate itself or distribute itself for the next move. Okay. This is a interesting chart of these markets that we have been discussing. So here's the S&P, here's the NASDAQ 100, the Dow, and the Russell. And so here we can see how much fuel is in the tank here for higher prices. So the yellow shaded areas represent the areas where I've taken point and figure counts, and we actually did these counts, and I believe we showed them in June here on Market Watchers Live. So you can see that these yellow counts, and this is the final peak, 2940 for the S&P, the NDX 7700, etc. I want to now show you the point and figure charts. And these are the actual counts that we put up at that time. And this is just a great indicator of how well these point and figure charts can help you with your trading. So we saw that at the time, back mid-year, that we had an account here, reaccumulation or an accumulation count that went up to 2950, 2990. And we missed that by one box, 2940, 91. So these are 10-point boxes here. In the NDX, you can see that the NDX actually overshot this this small count and didn't quite reach the big count. But this is just, I mean, this is what a great tool this is, because this told us that accumulation had formed and prepared the NDX for an important move upwards, and it went up to 7,700. The Dow Industrials, which is one of my favorite for point and figure counting, here you can see that it went to 26,951, 952, and that split almost got up to the high count here on this base. And so we have fulfilled that count. And here, the most troublesome of the four big indexes really was the Russell, because the Russell 2000 was unable to complete its move on these two counts up to the 1830, 1850 area, and only got up to 1742, which actually was a sign of weakness for the Russell, that it couldn't achieve its point and figure counts. And so I just wanted to show you those. And let's see, we have time. This is an interesting chart that kind of speaks to the current moment, and that is this is the Dow Industrials, and this is 5-minute data, 3-box reversal, 40-point scaling here. And so this is the recent well, let's call it a minor accumulation area that occurred after the big October decline. And I'm somewhat encouraged by this. And we have a smaller count here that was counted across and gave us an objective of 25,960 up to 26,320. Well, we got to 26,277, which put us right in the middle of this lower count, and then it's rolled over at that point. But I think there's reason to be encouraged. So if you can see this chart, this is that area right here that it rallied up into. Well, look what's happened since. So this is the area that we counted across here. Let me see if I can. So this is what we counted right here. And this takes us up to the smaller count, but look at this bigger count that's available to us. And so we can see that today that the Dow is making a slightly lower low, and quite honestly, it's back to this old resistance area, which is now new support. The thing in the near term that gives us caution is the amount of weakness that we've had off of this big peak here. But this is not unusual to have that kind of weakness. But it does say that there's a lot of supply latent in this market, and that what we need to see is the end of the decline, and then the ability to start to rally again, and put a rally in, sort of like what we saw back here at the beginning of November, where it rallied up, was able to take out prior peaks, and then pull back with shallow pullbacks, and then have really good rallies again. So I believe that's possible. I think that this isn't surprising that there is still a lot of supply in this market. But if we can consolidate this, and we can stop going down and start to do something akin to what we did off this spring and test here, and start to do the higher highs and higher lows, I believe that we could count this as a point and figure count, and this would generate a pretty big count. So, and this count here from the LPS over also is a pretty big count. So on that, that's what I have for now. But again, I think we're in a period of rotation. I think this rotation is very important. I think because of the current environment and how capital is being treated, I think that we're getting rotation, and this rotation is moving us towards other areas of the market, which is going to create an opportunity. And we just have to be on our toes to see where the money is flowing to. And I believe that the growth names are going to be a source of capital to go into the value names as time goes on from here. So that's what I got for now.
Okay. Well, first of all, I mean, I was just sitting in here mesmerized. I'm sure a lot of the viewers are doing the same thing. I mean, I could listen to you talk for a long time about this stuff. It's very fascinating. And I think some of your earlier discussion about how, you know, we're looking at a market for a while driven by growth stocks, and then it kind of rotates, and then you see the value stocks take over. I think that those are some compelling points because we have seen a lot of these growth stocks, especially many of the software stocks, have gotten hit so hard over the past couple of months, and so there's certainly something to be said for the money that's been rotating of late. I know in the room there was one well, there were a few questions, but I know one in particular about an individual stock, and we still have maybe a minute or two. I don't know if you can take a look at this one, Bruce. But how about O'Reilly? ORLY. Do you have any thoughts about that that stock and where we might be as far
Well,
as
I've been kind of intrigued with these auto parts companies, and see if we can make a picture here. So look at this. Now this is again a 30-minute chart. I'll go out to daily, but beautiful. Look at climactic decline, automatic rally, secondary test, and now look at the volatility come out of this. So this is the thing that we look for in Wyckoff, is this. The volatility just becomes lesser and lesser as we go along. We generally look for lower volume through this, but look at this resolution here, higher lows throughout, and now this beautiful rally upward from here. And look at how well O'Reilly's acting relative to the market as a whole. This is just really a very interesting looking stock. And then here's a daily. So beautiful. It's a reaccumulation structure, shakes out at the end and tests it, and now this beautiful rally. And so another one that I was looking at here, which is Advanced Auto Parts, similar story. I like them both. They look great.
Awesome.
So Tom, you may have some comments about this.
Well, I mean, I do. I don't specifically talk about, you know, Wyckoff the way you do. I mean, I don't know all the terms and phrases, although I've learned a lot more from you since you've been coming on the show. But I do think I look a lot at stocks and charts in a Wyckoff-ian way.
Oh, I totally get that, because when I listen to you, and I'm a member of the audience, and when I listen to you, you exude it. There's no question.
Exude.
Because this is just good charting practice. Whether or not you use the terms of Wyckoff or you learned it with other terminology, it's just best practices for charting.
Well, and I think too, when you're looking at a chart, it's not just about, okay, did it go up or did it go down, or the MACD or the PPO or PMO did this, that, whatever. It's about the chart telling a story from a longer term perspective. I think under Wyckoff, you know, when you're looking at these charts over the past, you know, if you're looking at a daily chart, maybe the past couple of months, maybe a few weeks, and you're seeing what appears to be telling you a story about the stock, like here with Advanced Auto Parts or O'Reilly, where it kind of goes into that sideways. You know, you get those huge moves down, then you get that automatic reaction back to the upside, and it establishes trading ranges for you to watch. And then depending on how the stock trades after that, kind of gives you a sense of whether or not the stock has a better chance of going higher or lower. And of course, with your point and figure and all coming out with many of those projections, it gives you not only whether you're bullish or bearish, but also gives you targets to look for, which is very important as well.
And of course, that's what I love about point figure, and I'm just crazy for point figure. But
Yeah, you have to come on here more often and teach me about that because that's
Exactly.
I've just never really gotten into. I know Greg Schnell does it a lot, and I mean, I know some of the basics. I know enough to get me in trouble.
Yeah.
But your targets that you use, I've seen so many times that they play out to that. It's really fascinating stuff.
Well, I'm happy to do it, and I'm love talking about point figure. Zach had me do a two-part series for Stock Charts TV on point figure basics, and every so often they re-show those, and so I encourage people to look for that. And so Zach, hint hint, it's like put it in the programming again, because I think it's a great primer on how to do this work. And then what it does is, so for instance, here's FireEye, which is a stock that we've talked about over time here. Is this is a huge point and figure count, and this count you can take it in segments, so you can take little pieces of it and then take the whole thing. And FireEye is now at the point where it's trying to break out above this resistance area. Now, I think it could have to do some more work here and maybe pause, but notice how the stock just does not want to go down with the market. And so there are, and this is an important point to make here. It's like, I'm not against growth and just in value now. I'm just saying there's always great ideas in both areas. But as a general theme, where's the money flowing from and where's it flowing to? And the other thing that's attacking the stock market here is that when the economy gets hot, and here we have a near a 3.5% GDP economy, well, now the economy is starting to take money away from financial assets. It's become competition with financial assets for funds. And so this is what happens when you get late in the cycle and the economy gets real hot, is not only is there competition between stocks and bonds and other financial assets, but now the real economy, which is, the elephant in the room, is starting to draw money away from the stock market. And so it's all competition. It's all about money flow.
Mm-hmm. Okay, Bruce, it is always a pleasure to have you on the show. Thank you so much for joining us, and we look forward to having you back soon.
So much fun to be here. I appreciate it, everybody. Thank you.
Hi, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. Today's instructional video will show you how the dynamic yield curve works. Here are the topics in the timeline for today. First, we'll show you how you can access the dynamic yield curve. Then we will go over the parts of the page. We'll show you how to work with the trail length. Then we'll show you how to compare using snapshots. And finally, we'll go over the clear, animate, and show info functions. Accessing the dynamic yield curve. I'm here on the free charts page, and there are two places you can access the dynamic yield curve. The first is on the right navigation. You see charting tools, and at the bottom you have the dynamic yield curve link. You can also scroll down the page, and you will see the different sections, and you see a section for the dynamic yield curve, and you just click that button to launch it. You can also access the dynamic yield curve from the members page if you click on that link at the top, and on the left you have your control center, and if you scroll down you'll see charting tools, and at the bottom you will see the dynamic yield curve. Parts of the dynamic yield curve page. On the left-hand side of the page, we have the yield curve itself, and that is shown in the yield curve pane. The red line is the yield curve. On the y-axis, we can see the range for the yield. On the x-axis, we can see the maturities, 3 months, 2 years, 5 years, all the way to 30 years. On the right side, we have the S&P 500 for reference, with the date scale at the bottom and the price scale on the y-axis. The current date shown here is the 27th of October. And on the right, we have the date slider. and you can move that date line. I can click and drag it to a particular spot, or I can click anywhere on the chart to move it. So if I see a high here and I want to see what the yield curve looked like then, I can click right there on the chart and then look at the yield curve. And I can also slide this and the yield curve will change as I slide along the date axis of the S&P 500 chart. At the bottom, we have some other controls: trail length, snapshot, clear, and animate, which I'll go over in more detail in a minute. And we also have links for quick tips, instructions, and a permalink if you want to share that chart. Working with the trail length. Chartists can use the trail length to see how the yield curve has changed over time, and it's about a 6-month trail. So I've selected the 2007 high on the S&P 500 as my starting point. If I go to the trail length slider and I move that out to the maximum, you can see how the yield curve has changed. The shorter yields were above 4.65% at the beginning of the period, and they moved down as we came into this point in 2007, September 2007. And again, we can click on any point on that S&P 500 chart to see how the yield curve looked at that particular time. And you can see I'm near the 2008-2009 lows. The current yield curve is in red, and you can see the darker lines show how it has changed over the last 6 months or so. You can see the longer yields have come down significantly. Comparing with snapshots. We can also use the snapshot feature to compare the yield curve to various points in time. So again, I'm going to go to this 2007 high because it was a significant event here. And you can see the yield curve as it is now, around 4.65% roughly. And I'm going to take a snapshot by clicking the snapshot button. Now, when I click on the red date slider line, I'm going to see how the yield curve compares to that snapshot. So I'm going to go ahead and stop it at the 2009 low. So we have our snapshot in 2007, and now you can see at the 2009 low, the yield curve looks completely different. Using the clear, animate, and show info functions. If I want to remove the snapshot that I've taken, I would just click the clear button there, and that snapshot will be removed. You can also animate the yield curve to see how it has changed from a particular point in time. So again, I'll move to the 2007 high, and if I want to see that exact high, I can click the show info box, tick that box, and then scroll up to see the high and the price. If I click the animate button, I will get an animated yield curve. So you can see the yield curve is changing as we move along the date axis of the S&P 500 chart. I can always pause that if I want to see the yield curve at a particular point in time, and then click animate to reanimate it. And that concludes this instructional video on the dynamic yield curve. Thanks very much for tuning in, and be sure to check out our other instructional videos.
This is a brief demo about how to scan for things that made a new high earlier in the week or the month. Rather than using a daily scan, which would say that it didn't make a new high today, by using a monthly scan, it'll get anything that was above this previous time period. So to do that, we go into technical scans and we create this month's high is greater than last month's maximum over the previous 12 months. I've also set it up with a close greater than $5. But when we run that scan, obviously it brings us our data, and what we can do is we can sort it into industry and sector, and Buckle was the current stock that I had up there, but look at how many apparel retailers are also hitting new highs in this current month. So this would lead you to believe that there's some strength in that sector.